7th, and this is first session of the wyckoff trading course. We're going to have 15 sessions, and it's always exciting to start the new cycle, to meet new people, new traders, new wyckoffians that are coming into our new universe and becoming part of our community, and we welcome you. And for those of you who are guests, just for this session, please enjoy this session. If you have any questions, email me, go to our website, browse through our products, offerings, free offerings. Maybe you decide to attend other classes. And if you have, questions about the course, I will be happy to answer those either via email or today. You could always ask the question, just typing it in. So for those of you who already signed up for this session, there are two groups of people, actually three groups of people for this session that we are having today. The first one is students who already signed up, and you are new students. You haven't taken this course before, so I will be addressing you in a specific way. I will be, throughout this whole lecture, I will be giving you certain instructions as to what am I expecting from you a week from now. We'll talk about the homework. We'll talk about some books that I'm going to recommend, some additional material that I want you to read or to view. The second group is the alumni. And it's always fun to have students who have gone through the course and they come back, just because there is so much material, and just to absorb all of this material in one setting could be a little bit hard. And I've had so many great comments from alumni when they take the course for the second time, and obviously we give you guys a discount. So for those of you who are alumni, if you feel that you need to refresh your knowledge, and obviously from each cycle to another cycle, I hope that I'm improving the material, adding to the material, or explaining it in a different way. So hopefully that's going to be helpful. And the third group is guests. So again, for those of you who are guests, welcome, and I'm so happy that you're here. Our wyckoff price structure series, the beginning, the first 4 sessions, starting with today's session, are going to continue into January 14th, 21st, and 28th. We're going to meet at 3 p.m. Pacific. For those of you who know me, I'm extremely bad with time management, just because I want to give you guys a lot of the stuff. And sometimes we kind of, spill over just a regular 5 o'clock ending for the class. So this cycle, and this is the new innovation, I decided that officially we're going to have the class for 2.5 hours, from 3 p.m. to 5:30 p.m. Pacific. And as you know, those who attended these classes before, sometimes we go to 6 o'clock as well. Sometimes I feel like we need to finish the exercise, so we need to finish a lecture, and we'll do that. So I would say that, keep like 3 hours for the live session, and obviously you don't have to stay through the whole session if you need to go. It's all understandable. And if you are unable to attend a live session, or we have so many international students that live across the globe. For those of you who live outside of the U.S. Or this continent and this time zone, all of our sessions are recorded, and I post them each evening after the class. And usually, the latest by the next morning, you're going to have the video from the last class and the slides as well. For those of you who are guests, to register for this course, go to our website, wyckoffanalytics.com. You could find the course either on the homepage or just browse through the website and find the correct pages. Sign up. We have a discounted price right now at $9.98. That will last probably until January 14th. and that is for the 15 webinar or recorded sessions. All of the recordings and slides will be available to you guys, who signed up for this class. This particular session will be posted on YouTube channel, so right away, please make a note of this right here at the bottom, left bottom on the slide. I'm posting an announcement that we are recording this session, and it will be on YouTube. If not tonight, then by tomorrow morning. And again, if you need to go, just keep this in mind, and you can watch it at your convenience. A really quick announcement for students who already signed up for this course. There is a specific way how I want to receive your homework, and we've been doing this for over 15 cycles now, and yeah, I think even more, maybe more than 20 cycles. I want you to submit your homework just in one file. I don't need to receive multiple files from you with all of the charts. Please combine those into one file. And my preference is always PowerPoint or the PDF or the doc format, the Word doc format. And obviously, I want to see your first name. You don't have to put your last name, and you could mention what number of the homework it is. I save all of your homeworks. I go through all of them. I review all of them. And the reason why I do this is because I need to understand what kind of mistakes we're making as a group, what kind of commonality we have among us in the way how we view the instructions, the material, and so on and so forth. And I'll talk about this more as I will explain next week's homeworks for you guys. And the last announcements, and this is extremely important for those of you who signed up. Our classes are extremely interactive. The first class is the only class that is a lecture. Everything else is a class where I'm going to be lecturing, and then I'm going to open up the mic to either a specific student or to everybody, and everybody could comment. And as we go through the exercise, I will converse with you. So this means that I would like you to have a microphone available to you. Usually I recommend a headset with the built-in microphone. That works the best. That's what I'm using. As alumni might tell you, or other students from other classes, there is a lot of interaction that happens in this class. The reason why I interact with students is because I want to understand how you think and what is the issue in your analysis. And it's throughout the conversation that the truth kind of comes out, and it's easier for me to teach that way. And it's been like this for years and years, so that's a very common thing for us to do. All right, so we're done with this. Let's look at, and obviously everything that we're discussing today in this lecture is for educational purposes only. You can stop the recording and read the whole disclaimer. What are we going to look at today? So today, as usual in the first class, I'm going to show you some examples of my trades. Yes, I do trade, and I teach what I trade. I trade, my predominant time frame is a swing time frame, and there are a couple of distinctions there that I usually have, either very short swing trades from a couple of days to a week or so, or swing trades that last for months. And then I also started doing, in the last 2 years, a lot of campaign stocks. So I'm going to show you some of those trades as well. And obviously this is just something to highlight the method, the analysis, the execution, the tactics. I'm also a person who is extremely honest with my students, and I show my mistakes, and I think that I need to I want to be in the space of honesty with my students. I want you guys to show me your mistakes, and I'll show you mine, and together we're going to learn from that. We're going to analyze, we're going to post-analyze, we're going to figure out what is it that we're doing right or wrong. So this is the type of relationship that I usually build with my students. So today we're going to look at 4 trades, 2 of them on the short side and 2 of them on the long side. Some of them were great trades, some of them were good trades, and some of them were bad trades. So we're going to look at where mistakes were made. Also, and this is something that I usually don't do in this class a lot, but whenever the market is extremely active, I tend to discuss the market almost in each class, just because I know how difficult it is, to be exposed to the market. And then when something happens, obviously students have questions, and I'm bombarded with emails, what do you think, what's happening, could you look at this and that. And I will talk also about the wyckoff market discussion class that we conduct on Wednesdays. Currently we have a promotion, I'll mention that. So I think it's appropriate today very quickly go through the market analysis. Then after that, we're going to do the course overview. I'm just going to touch on the main subjects that we're going to cover in this 4 series. And then after that, we're going to start with the actual course. We're going to start with the introduction to the wyckoff method. We'll talk about Richard Wyckoff himself. We'll define what composite operator means to us. We'll talk about the price cycle, which is a predominant framework for us. And then we'll start with the main structural concepts, which is a change of character and then the traits of the accumulation and the distribution. And obviously, this is just an introduction. This is something that I'm just giving to you guys to maybe even think about what's coming next, and to think about the benefits of this knowledge and how you could apply this knowledge in your trading. And then we'll definitely look at the homework. Next session, for those of you who already signed up or who are planning to sign up, we're going to go into the details of the price structural analysis. First, we'll review the homework. And by the way, the most common question from students who signed up was obviously about the recordings. So you will have the recordings almost instantly. And then the second most common question was, can I email you a question and ask you if I don't understand something? You can definitely do so, but my preference is to look at your question and answer to the question during the session. There is a much more value for me and for students in the class if I answer your question in the next class. And obviously, I want this question to be related to the content that we are discussing at the time. So any questions that might be covering some material that is ahead, I'm just going to say we're going to study this later on. Or I'm going to say keep this question for session number 15, which is going to be our Q&A session for us. And then some of the questions that does not require me to write a lot, I might just quickly write an answer. But predominantly, we will be answering and looking at those questions during the next classes. During the next class, we'll talk in session 2 about reaccumulation and redistribution within the structure of the price cycle. Some distinctions there are, some labeling distinctions. And the biggest question here on the reaccumulation and the redistribution is, let's say with the reaccumulation, is this a reaccumulation or a distribution? And it's, the market obviously gave us such a puzzle in 2018. And I think that puzzle is still unfolding, by the way. It's by no means that we are, out of this formation yet. It's just still keeps unfolding. But we'll talk about the traits of the reaccumulation and the distribution, distinctions between reaccumulation and the distribution, distinctions in labeling, and so on and so forth. And then after that, we're going to go into the details on the price structural analysis, where we will discuss how to identify the phase boundaries, and we'll talk about the phase analysis. Why do we need that? And we'll talk about this today a little bit. We'll talk about phase C identification. For those of you who are familiar with wyckoff methodology, phase C is kind of like a very crucial phase in the price structure. And within that structure of phase C, we'll talk about types of sprints and shakeouts. Those are specific price action that we identify. They happen in a specific way. So we want to be able to identify those and develop the skill to recognize those as they happen. We'll talk about the sign of strength, and that is beyond phase C, going into the next phase D. So in sign of strength is going to act as a change of character. And that's session number 2. Each session will have some kind of homework. So one of the things with students from each of the cycles that I've conducted was that the course is too intense, and that it requires, definitely time to follow the course. And unfortunately, I have only marginally valuable answers to these comments to you guys. I think it's always a pace of a specific student that I'm discussing. If somebody has time and you are very serious about this knowledge and you want to get it as soon as possible, then yes, you have to do the homework each week. And if you skip it, then make sure that you come back, you do it, you send it to me, and then you watch the video with the review, or at least you have some kind of questions. If you don't have a lot of time to do the homework, then I think the best assignment for you is just to make sure that you just go through the video, and as you go through the video and you watch it, I want you to make some notes. And those don't have to be very extensive notes. I just want you to kind of like stop the video, think about the concepts, write those down, write those concepts in your own words. And that would be the best thing. This way you are acquiring the knowledge, you are absorbing the knowledge. And during this course, I will be repeating concepts over and over and over and over again, because that's how our minds work. Our minds are, and especially if you, as myself, not that young, it takes time, to go through some of the concepts, and there's nothing wrong in that. We just need to repeat them over and over. So as you could already maybe see, I'm extremely passionate about this material, trading in general, wyckoff method in general, and my students as well. I like to see the progress. I like to push you guys. So I kind of have a tendency to be a little bit, kind of pushing you to the limits that you allow me, to push you. And I think, that's one of the values of this course. And I've heard these comments before from students, that they appreciate my teaching style, and I appreciate that comment, and the fact that a lot of them just come back. But that's the intensity, and that's the style that I have. And again, if you feel that it's a little bit too much, it doesn't mean that you don't have to take the course. Take the course, but go at your own pace. You could always, buy the course and then go and watch the recordings at your own pace. Send me homeworks, send me questions, maybe come to the live session if you want. I would actually do both if you have time, live session and then watch the recording again. Again, this session is being recorded, and I will post it on our wyckoff trading method channel on YouTube. By the way, check it out. We have quite a few videos now, and almost each week there is some kind of update. There is some kind of upload of a new video. So check out our channel. And for those of you who want to sign up, go to our website. Currently, the price is still a discounted price, so make sure that you sign up before it goes up. All right, so let's start with the first case study. And the first case study, well, because there's such a bearish sentiment right now, and obviously, rightfully so, we have had lower highs, lower lows, a conventional T8 definition of a downtrend. So obviously, I wanted to look at trades that I've done that were on the downside. So we'll look at Nova Deer and we'll look at Russell 2000. And here are these two trades. First, let's look at Nova Deer. So Nova Deer was a very interesting case study, and I think that it probably requires more time to spend on this and to fully understand how and at what point our bias is changing, and at what point tactically we would be going into this position and establishing a short position. And again, I'm extremely honest with you as to what I thought or what my trades were at one point or another. So as the price was still making higher highs and higher lows, my bias was still to the upside. And in a lot of cases here in this trading range, you would see the benefit of that. Obviously, Nova Deer was such a big leadership stock in this business cycle that we've had. It was one of the best stocks to have for companion. It was one of the best swing stocks as well. So there was nothing wrong here, in my opinion, in this trading range to still have a bias to the upside. Because if you're a swing trader, you're going to initiate your positions close to the support. And then whenever they fail, that's when you want to get out of those positions. So even in this upsloping trading range with higher highs, higher lows, you could manage, being maybe not entirely right on the long-term bias, but be right on the short-term bias and still extract some money out of this. Also, please note that because of the leadership characteristics, because of the strength that this particular stock and the group, semiconductor group, has exhibited for years in this business cycle, the distribution does not necessarily look like a distribution. If you look at the first initial reaction that starts with the buying climax after the climactic run, which we identify in this course as the first point of excitement, look at the initial reaction. It happens on 3-4 days down, very quick sell-off, but then a very quick run-up to the same highs. So what does it tell us? Someone's selling, but somebody's still buying. Some institutions are still seeing some value in the stock. So at this point of time, we're just noticing this price action, price development, and we are saying that there was a change of character in the way how the price was going down on big volume signature and how it quickly recovered. And at this point of time, we would be thinking that we're going to develop a trading range. That's our logic at that time. We know that we're in the potential phase A, which should show us a buying climax, automatic reaction, and secondary test. So all of these 3 points are here in phase A. So again, at this point of time, you might be thinking this could be a reaccumulation. And that's exactly the point of view that I had when the market made a high at the end of January and had a very sharp reaction into the February low. Nova Deer looked very good. It looked much, much better than the market itself. So this is a natural tendency for us to get, and to the stock and to select the stock that has those leadership characteristics during the times of market volatility. Then I'm not going to go through phase B. There are some points that we could talk about, like a minor sign of weakness here, attempts to upthrust, the way and the texture of the price and the volume signature that suggests that there is no supply at this point of time, and that suggests a rally, which does happen, and it happens in very familiar way of how some of the rallies in the trading range develops. And as we are reacting to one half of the range, and on the next rally, we are attempting to overcome the point of upsloping resistance. We see that there is only a temporary commitment to the upside. There is only one bar, one close that is above the previous high. And then the price just quickly fails back into the trading range. So therefore, a question here is, why would this happen? If the stock is so strong, why is it failing on the breakout? And we obviously could see that as the price goes back into the trading range, there is a gap, there is a down spread that is increasing, and also supply is increasing. Those are all elements of potential institutional selling. So we want to make sure that we are not necessarily shorting a leadership stock right away. There were so many other stocks to short before that, even before October and September, that were already in the downtrend. If you look at some of the stocks, even if we look at Russell, look at the September action, compared to other indices and other stocks, you could see that stocks in Russell 2000 have been exhibiting already the weakness. So on the first leg to the downside, this is where you have to be. You have to be in the weaker asset. But as I was actually conducting a presentation for stockcharts.com on Market Watchers Live, I actually had this position, and I've entered this position on the second leg to the downside. This was the actual bar where I've initiated this position, and this type of the positions I always conduct with options trading. So I just bought directional options with and I have to look it up a little bit better, what was the expiration. But usually for this type of short-term trades, I would have the expiration a month or two away. I'm expecting a drop to the downside, and I'll explain in a second why. But first, let's talk about the timing. Let's talk about the selection. How do we transition from a leadership stock into the stock that is for sale, and into the stock that we could short with confidence? Well, this whole move right here, look what happens here. It's a change of character. The stock is starting to behave in a different way. We're seeing multiple gaps at the open. We're seeing how the down spread is increasing. And comparing this move to the previous moves to the downside in the same trading range, this is probably the most aggressive move to the downside. Not only that, look at the distance that it traveled. This is the largest distance to the downside in this trading range. So if they sell, they actually progress to the downside. We will be discussing in the second portion of the course the relationship between volume and price, or as we would identify it in different terms, the relationship between effort and the result. So we're seeing for the first time that all of the attempts to push the price down in the trading range were unsuccessful. And for the first time, not only the distance of the reaction has increased and the character with which it moves, but also we are seeing the increase of the supply signature, or rather increase of the downward effort. and it's been synchronized with the downward result. And that's what we're looking for in the selection of the stock that has concluded some kind of formation and now shows to us that institutions are selling at this point. So that was the determining factor for the selection of this trade. Everything else was kind of very much mechanical, because tactics are tactics. They're not going to change. We're identifying the first leg to the downside as a sign of weakness, and then look at the rally. A very weak rally. It cannot even come back to 1/2 of the trading range, and then it just fails. So the position was opened on this bar right at the open after the price went through the previous low, and it was an enjoyable trade just because it happened so fast. So from about 236, to 188, that's about what? So almost like $50. And it happens so quick. 1, 2, 3, 4, 5, 6, 7 days, 7 trading days. So a week and a half. And let's see, if you are a swing trader and a short-term swing trader, this is a very quick profit. And also think about the leverage, right? So I'm putting on puts options. So I'm definitely leveraging this position. Now, the reason for closing the position was that we have made a low below the low of the automatic reaction. And we are clearly in the oversold condition here. The volume signature is not that climactic, but we're anticipating that at this point, we might have some kind of stopping action. Why? Well, because selling does not happen consistently. There is always some kind of institutions that are going to find some value as the price moves to the downside. Because if they are holding their position and they are thinking, well, Novadear was a leadership, even in this climate, I'd rather hold on to this stock because it's a leadership stock, then at some point, as the price goes to below the point of where they bought or they thought that there is some value, they're going to step in and they're going to start buying. And we see that from the volume signature. So a lot of the conversations that we're going to have throughout this course is going to be about institutional sentiment. Where do they find value? And where do they find liquidity? Those are the two things that institutions require in order for us to they require in order for them to open the position. So increasing the volume signature suggests increasing the institutional activity. And we see that there was a move to the upside. So some of them were buyers at this point. There was no reason for me to wait for a potential trading range to develop. That was the thought at the time. So the exit was just at the close. And initially, I thought that my analysis was correct. And I thought that after the selling climax and automatic rally, we had a secondary test, and we are in phase A, and we're going to continue a trading range until the next leg to the downside as a continuation. Unfortunately, it didn't happen that way. The price just tanked, and it tanked on the institutional capitulation. This is where institutions are just giving up their positions. And we must say that there is a difference between a strong hand or a weak hand. There is, institutions that are acting at this point of time as strong hands, and some institutions are acting as weak hands. So obviously, capitulation happens on the selling of weak institutional hands. And then some of the strong hands that are seeing that there is some value that was not there for them at 190, 180, but they've seen some value at 150, 140, 130. So they are stepping in and they're stopping the price from moving further down by initiating their buy positions. So that was a relatively easy and quick trade. emotionally very stable because the price basically drops, and that's how it usually happens during the bear market. And I really enjoy actually shorting. It's just that we haven't had an opportunity to short for quite some time, and I don't mean just short, specific stocks, but market in general. Talking about the market, so as we are continuing with the development of the bearish sentiment, in this area right here, I had quite a few calls to the upside, and I'm actually totally okay with that. There are two things that you have to remember. It's all about the context of where we are and how we trade. And the context here is that as we have already established, let's say, a bias to the downside, it doesn't mean that there are no trades to the upside that we could exploit, even on a short-term basis. So as the market was going down in the second leg right here, we could see that the supply is actually being exhausted. And my call here was to the upside, and I still stand by that. And I thought it was a great call, because the call was just for a swing trade or for the rally to happen. And actually it happens, a couple of times actually on other markets, on other indices, that was even better. So I'm going to show you some of the trades in this area right here if you're a swing trader, and how to exploit that. But in this case, a continuation happened after a failed sprint. And we'll talk about the sprint and the definition of the sprint later on, guys, so don't worry about that. But it acted as a failed signal. And a failed signal is probably the best signal in technical analysis that you could find. Why, Bill? Because usually a failed signal will have a very quick shift in the sentiment, where the majority of traders were on the wrong side of the trade, and then as they close out their positions either via stop loss or capitulation, that produces a big counter move to the sentiment that preceded that. And we kind of see that it happened exactly this way. Well, first of all, we are coming out of the apex formation. So here we're thinking that the velocity is going to increase on the way down, if the sprint fails. And as it fails, it gives us a very, very great tactical place to open the position, which obviously I took advantage of. And not necessarily was the best exit right here. And, I think that further down the road, we could discuss this, whether in the wyckoff trading course or in the practicum. But I still felt that it was much better than not to be exposed to the market at the time when the bias was so bearish. That's number one. Secondly, at the time I had some long positions, which were campaign positions or even swing positions, and I wanted to hedge. So one of the ways to do that is exactly this. You could hedge through opening the position, let's say, against some of the positions that you have with the different buys, and that was the idea, and it worked out somewhat okay, somewhat perfectly. I'm just kind of thinking more about the exit here. My preference would be to exit a little bit lower right here on this close. Why? Well, because this shows to us, this bar shows on the volume signature a climactic action. So this was more truer selling climax characteristic than on the previous bar. And the reason why I was thinking, now I'm remembering this, is just the close that had a little bit of the uplift, and that we didn't really experience before that. So I remember that was the thinking. Also, look at the oversold condition right here. Even this bar, the exit bar, has been already in the oversold condition. And so therefore, and the volume signature was relatively high. It was one of the highest that we have had. And if we use the analog of how the price actually stops here, there was a suggestion that somewhere here there might be a stop in action. So that was the logic. But definitely could have been a little bit better as an exit. So these are the couple of trades that I've conducted during this bear market. But as I've mentioned, there were some trades that I had on the long side, and I definitely want to acknowledge that. That's number one. I want to explain the logic. I want you guys to understand the logic. So we'll go through that, and hopefully after this post-analysis, you kind of would get a feel of, first, how I trade, secondly, what I teach, and thirdly, and more importantly, how could we use wyckoff methodology to define the selection and to define the tactics for us. A question here from Eric. After the sign of weakness to the exit at 188 is better not to operate? Was that the question, Eric? Okay, so after the sign of weakness to the exit of 188. Okay, better not to operate? I don't know, it worked out, right? So I think what happened here is that institutions started to sell, and there was not a lot of selling, actually. If you think about, what this move to the downside, what it had in terms of the force to the downside, we could see the increase in the supply signature. But if we would compare it to the previous attempts, to sell off, it actually was less of a force to the downside. Yet, look at how quickly we move into the downside. So it means that there is no resistance for the price to stop at some point and to react to the upside. There are no bias at this point. So that was the logic of the continuation. Okay, and Eric, hopefully I understood your question. If not, you could just re-ask. Let's look at the next case study. And this one is a Canadian Solar. This particular stock I have been stocking for some time. And I'm going to go through the analysis first to the point of entry so that you would understand the logic of why I'm in this position. I'm still currently in this position. This is a campaign position, meaning that I'm going to hold on to this position for quite some time. I want this position to develop into a sustainable uptrend where not only this stock, but the group itself and the peers are going to confirm that we are in the campaign mode. And it all starts with phase A, where we see the final climactic action with increased spread, gaps to the downside, huge volume signature that represents both increase of the supply and increase of the demand. Increase of the supply from weak hands and increase of the demand from strong hands. And I will teach you how to identify those two categories of traders, and on the price action and the volume action. And then multiple tests, which I'm putting into phase A. And then phase B was very interesting. The whole selection for this trade was based on phase B. And somebody might be thinking, who knows wyckoff methodology, what the heck? What is he talking about? How could you define a selection based on phase B? Well, look at where phase B is residing. It's residing on the top of phase A and early phase B. Also on the top of the potential preliminary support, which happens before the climactic action. What does it tell you? Well, it tells us one thing, that institutions bought into this position, and then they didn't want to get rid of it. And the shakeout has specific characteristics that we will study And this shakeout happens so fast, it doesn't produce a lower low relative to the climactic action. It's actually a high low. And look how quickly there is, after the capitulation, which is still institutional capitulation, they are thinking in terms of the quarters. So multiple quarters, the stock is not showing absolute return, and the stock is not showing relative return. What are they going to do if the stock starts to go down? They will get rid of it. They will get rid of the stock from their portfolios. And this is exactly the volume signature and the price behavior that tells us that story. So out of this, we have a relatively quick recovery, which tells us that this was just an kind of institutional short-term capitulation where a lot of other institutions actually picked up all of their shares. And we're seeing multiple tests. By itself, this low is a test to the previous lows in phases A and early B, then multiple local tests, and my point of entry actually was right here. So what am I seeing here? Well, I'm thinking that from this point on, we probably gonna just go up into a potential sign of strength, into phase D, meaning that we're expecting the price to overcome all of the levels of the previous resistance. And then it doesn't happen right away. There is a smaller shakeout. And, you know, one of the things that, we study is that type of the behavior. When you identify the character of the stock as to how it moves, how the price moves, and obviously that's all being based on how institutions are behaving or how weak hands are behaving. And this type of shakeout is to be expected, as we have seen before this type of the behavior. So you should not be extremely concerned until the price actually hits our stop loss, which is below the May low. So I'm still in this position, even the local shakeout is happening. I see positive actions here where there is a quick reversal of the low where there is some value, and then there is a test. So that looks great. Add to the position here, I just missed that, but wanted to have a confirmation. I wanted to see a positive positive position before I start adding to the position. So I let this rally run, but this rally was really great. It showed to me that indeed, this is the stock that is worth my attention. And the Wyckoffian structure is concluding. We are in the potential phase C, and we have the rally that has a lot of momentum. And remember, guys, from conventional technical analysis, momentum always will precede price. Quickly losing my voice in New Year. The next shakeout or shakeout type of reaction is all market related. It's not stock related, it's not group related, it's all market. Volatility of the market takes even the leadership stocks down. So therefore, we just need to assess as to what kind of damage the market could do to this particular stock. Again, we are out if our stop loss is being hit. There is no question about that, but it's not. Instead, we're seeing higher low, and we still want to stay in this position. And currently, I'm still in this position. The goal is very long term, but the logic as to how I'm getting in, how I'm selecting the stock, or how I'm getting into the stock, or how I'm going through such a period of volatility is all Wyckoffian. It's all of this analysis of staying in, adding to the position, or getting out of the position, all based on Wyckoff studies, Wyckoff concepts. And I kind of would like you to see the benefit, through actual trades of studying the methodology and developing the skill of visual recognition of all of those concepts. A couple of questions here. Okay, great. I like that the group is active. This means that we're going to have a good cycle. Hold on a second. All right. So this comes from Charles. Oh, Charles, hi. Just a thought about Eric's comment. By stopping to operate, he might have meant, should one have continued looking for immediate opportunity for new trades? Just a thought. Okay, yeah, I could see that point, Charles. You know, and we're still talking about Novadia trade, so come back to that trade, into that slide. You know, if you have any other thoughts on that, so I could definitely see that. And then again from Eric, in Canadian Solar Phase B, is that an upthrust or upthrust action, and what's the difference? All right, well, yes, we definitely have multiple upthrust situations here, right? So we have a first upthrust here, another upthrust here, another upthrust, another upthrust. So what are the upthrusts? Upthrusts are just temporary commitments to the upside above the levels of the resistance, and then almost instant return back into under that resistance. And we're seeing that in all of the cases, this is what we see. The price commits temporarily and then comes back under the resistance almost instantly. Now, the difference between upthrust and upthrust action, and all of them are just upthrust action, in my opinion, at this point of time, is that when we say that this is an upthrust action, we actually suggest a specific bias, which is to the upside. So upthrust action will be discussed during the accumulation and during reaccumulation. Upthrust will be discussed during the distribution or a redistribution. We will talk about this more and in more details, and specifically in session number 3 and 4, we will talk about the distribution a lot. And I will give you a lot of the definitions on upthrust actions, sprints, different type of sprints, shakeouts, and so on and so forth. So it's all ahead. All right, next question. In phase A, which is the automatic rally of the first leg to the intermittent line, or the candle with the weak point into the straight line. Oh, Eric, what's the question then? Which is the automatic rally? Okay, got it. Yeah, so Eric, I definitely feel that there is some knowledge behind it, behind the question. Actually, in my opinion, there are 3 automatic rallies here. You could, just because we're discussing phase A that has this testing, this area is a test, and it's kind of the conclusion of the testing of phase A. We had multiple attempts to go down, so this is of the same magnitude as the selling climax, so therefore we want the test to be of the same magnitude as the climactic action. From that perspective, we might have multiple automatic rallies, and this is again something that we'll go into the detail. This is a little bit more advanced, so usually this stuff we leave for the practicum, which is the continuation of the wyckoff trading course, and this is a little bit more of the advanced concepts, but really good question. From Justin. Ramon, how do you pick your entry point, entry prices? So I've developed kind of like a proprietary reversal mechanism where I'm identifying specific bars that are reversal bars and that act as what I call a point of no return. This type of bars suggest that a reversal has happened, and you need to, this would be the most optimal point of entry. It's below this points of entry, or rather the lows, where you could have the best reward to risk ratio. And these are the points of the lowest risk. And as Wyckoffians, we always want to open the position let's say if we're opening the position to the upside after the reaction, after reaction, after reaction, after reaction, there are two spots only. One was identified by Wyckoff himself, and then the second one we added in the Wyckoff trading course. And again, this is something that we'll talk about. We will talk in months number 4 in March, April about tactics. How do we get in? I will show you the Wyckoff way, how his logic worked on the entries and stop losses and exits. And then in the practicum as a continuation, we will definitely talk about this proprietary technique that I'm going to show you. All right, let's look at another trade or another case study. And this case study is about Shake Shack. For those of you who follow my analysis and follow us on either wyckoffanalytics.com or presentations that I occasionally give on stockcharts.com, you're probably familiar with this trade that I've done. I also have a description of the first trade on YouTube, so I'm not going to spend a lot of time on that. That was a really good trade, a really good swing trade. This is kind of like a very typical trade that I would have, in the market that is a bull market. So for the bear market, this type of trades are not necessarily going to work, and you will see this just almost instantly in a second. But this trade was great. It was based on the idea that the earnings are going to be having a favorable reaction, and we're going to have some kind of push into the overbought condition on earnings, and the plan was just to get out of this position on the excitement of weak hands that are still getting into this position, and therefore I want to leverage this. I'm using options, calls, and this was one of the profitable trades in 2018, which was kind of like vastly profitable, and you can see why. And the point of entry, the first point of entry, was on this bar. Again, this question as to how do you choose your entry points, I will explain later, but as you could see, a little bit premature entry. The add-on was much better, was much more optimal in terms of the point of entry. The price was the same, but I had to sweat it out for a couple of weeks into the next add-on. I'm adding here at the same price because I'm seeing what is happening here on earnings. As the price gaps down, it doesn't really go that much below the low. There is only one bar that commits to the downside, and then there is an instant recovery. So by itself, it acts strong after a negative reaction to earnings. And also, there is a much longer term structure, a trading range that has developed and had a major sign of strength, and we are in the potential backing up last point of support type of action. After that, everything is mechanical, kind of easy. There were some other points where you could add to the position. Here is one, here is another, here is another. And then before the earnings itself, you could actually, if you are a speculator like myself, you could create a position even here with the weekly options. And it worked out really nicely. I'm thinking that this is a buying climax, that we're going to have some kind of trading range at this point. A lot of supply that is coming in on this bar. Again, something that is not necessarily visible to a maturistic eye, but I will show you how to decipher the volume signature based on the price action to understand that the supply is coming in at this point. So I just closed the position, both of them, and obviously we see that supply has come in, but absorption is happening pretty fast. And that was the suggestion, to still keep at least a portion of the position as a continuation. All right, so that was the first trade. But the next series of trades that followed were in a different environment. Remember, the market environment from February, March, April lows, where we had absorption in the market of the supply. So that was favorable for this trade. What happens next?